We got some big news for CoreWeave stock investors as the company's management team elaborated on the impacts of tariffs and the implications for its business. I'll talk about what the management team said and what I've seen from other companies in similar industry talking about the impact of tariffs. Of course, this morning we got some new developments as President Donald Trump had held a phone call with Chinese President Xi Jinping, and there was positive news on developments for further negotiations. It was just nice to see that the relationship improved rather than worsening. So let's detail what this could mean for CoreWeave.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the management team at CoreWeave said, while we acknowledge the general global trade and macro uncertainty and volatility, we haven't observed any impact on customer behavior. In fact, we are seeing an acceleration of customer demand. Boy, that's great to hear if you're a CoreWeave stock investor. All of this volatility, there was a lot of question marks from stock market investors on how this would impact the boom in artificial intelligence. And what we've seen over the previous 4 to 8 weeks is that it's not having an impact, huge impact on the boom in artificial intelligence. We've seen reports from several companies now suggesting demand for artificial intelligence continues surging higher. And here we get another point of evidence from CoreWeave that it is still the case. The industry is still booming. The demand for artificial intelligence far exceeds supply. And so we've gone on even with these headwinds moving forward. The company did acknowledge, though, that there will be some elevated cost for certain equipment. However, these impacts are expected to be relatively marginal, right? So they are seeing higher cost of goods sold for some of their equipment, but it's relatively marginal. It's not going to have a huge impact on the company's bottom line, according to what management is seeing right now. Of course, if trade relationships improve, that will be great for CoreWeave and many companies as well. But if things worsen, then of course investors will need to pay attention and hear what the management team says then. We've got some macroeconomic data points coming out that give mixed signals. Some data points suggest that the US economy is still humming along, still doing extremely well. And then there's other data points that suggest that, the US economy is slowing down significantly. For instance, we got the jobs report, the jobs opening report, the JOLTS report, which was really good. It signaled that there was an increase in job openings, surprisingly. And then we got the unemployment report, unemployment insurance report that showed that there was an increase in people filing for unemployment insurance. So we're getting mixed signals right now from the US economy, whereas, I would say 4 months ago, 5 months ago, it was mostly positive signals. Unemployment was at record low levels and the growth rates were coming in very positive. So now we've got more of a mixed economy with the recession risks being elevated. So given that increase in demand that CoreWeave is seeing, they are adjusting their plans to both increase and pull in investment in our platform to meet this customer demand. Our engineering and operations teams are working relentlessly to deploy more capacity faster for our customers. Man, that just demonstrates how much demand there is for the computing requirements for artificial intelligence. What CoreWeave is saying here is not only are they increasing the investment, so let's say if they were planning to spend $100 million on capital expenditure to build new facilities, they're expanding that. So instead of 100 million, they're going to do 125 million, let's say. But on top of that, if they were planning to do these projects 3 months from now, 6 months from now, 9 months from now, they're starting them today. So bringing forward and expanding the amount of data center capacity they're adding that's optimized for artificial intelligence. That's how much demand they're seeing for their service. So they're just trying to get it up and running as quickly as possible, because as soon as they get it up and running, they have a customer that's buying that capacity. So the more quicker and the bigger they can do this, the more revenue they're going to generate. And they don't see an end in this. Like, they keep doing it, they keep expanding capacity, and customers keep buying up that capacity. And that's been true for nearly all of the AI companies I'm following, whether it's NVIDIA, here we have CoreWeave, Supermicro Computer, and others. They all talk about how demand for their products is soaring and accelerating, and they can barely keep up with the demand. They can barely increase the supply quickly enough. Even though they're all increasing supply, it's still not enough to meet this soaring demand. Looking ahead, the company said they expect second quarter revenue of about $1.1 billion, and they anticipate second quarter adjusted operating income of about 155 million at the midpoint. Pretty good operating profit margins for a newer company in the early stages of growth, and still generating positive operating profit on an adjusted basis while revenue is soaring. So their plans for capital expenditures for the second quarter are to be between 3 and 3.5 billion, reflecting a strategic decision to accelerate our investments to meet customer demand. So what I talked about earlier, right? They're accelerating, they're trying to bring forward as much as they can some of these investments to build these new data centers optimized for AI, because their customers are calling every day saying, hey, if you can get it up and running, we'll buy it. For the full year in 2025, they expect revenue to come in at $5 billion with adjusted operating income of about $815 million. Furthermore, and if you look at the adjusted operating income to sales at 815 million divided by 5 billion, that's close to a 20% operating margin adjusted, which is much better than what they are forecasting for the second quarter. And so they expect things to improve and accelerate as 2025 moves forward. They also expect to spend between 20 and 23 billion on capital investments. And if you see, the second quarter is just 3 to 3.5 billion. The first quarter was about 2 billion. So the first half of the year, they're going to spend about 5 billion. And in the second half of the year, they're going to spend between 15 and 18 billion on capital expenditure. So you can see the capital expenditure accelerating along with the revenue and adjusted operating income, as the company is just building as quickly and as much as it can to meet this absolute insane customer demand for its technology and services. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.